All right, welcome to a Chat with Traders community event. I am Nick Bradburn. I am hosting today and here with Christian Carreon, who was featured on episode 254 recently in the Chat with Traders podcast, where he discussed his box trading strategy and his history of getting into trading. And today he is joining us again for a more visual-based presentation to go over his box trading and how he approaches the markets. So welcome, Christian, and I will turn it over to you.
Thank you. I'm glad to be here. Let me turn off some other things so we can just be us. Great. So let me share my screen. I wanted to take you guys into sort of my philosophy and approach to trading the markets. Are you guys able to see this? I just closed it.
Yes. We are on TradingView right now.
Yes, this chart of the ES, it's a other than the indicators, it's a pretty naked chart. Yeah, you guys are on the same chart.
Yeah, well, you got quite a few different channels and lines, and it looks like some EMAs going on with it.
Yeah, it's pretty much the ES futures, the E-mini contract. I wanted to start off with this because the E-mini serves as a market filter for me, which pretty much is in system creation, when in my studies in creating systematic strategies or algorithms, you sort of develop an idea that you want to use a sector, an ETF, maybe the NASDAQ, maybe the S&P 500, or if you're a big small caps trader, you want to do small caps. I am mainly a NASDAQ and S&P 500 trader for stocks. And so I use the E-mini or the S&P 500 as my market filter. And it sort of dictates what my positioning is going to be. Am I going to be bullish for the next few weeks, the next couple months, or am I going to be bearish? So I wanted to start off with this, and I wanted to sort of go over the three pillars of my approach, which is zones. I talk a lot about supply and resistance zones, or supply and demand. Trends, which are what we look to capture, what I look to capture, and boxes, which are periods of consolidations in the markets, in the E-mini. And I sort of tie all of those three together to create what is now a systematic strategy, the box strategy. And I look to extract capital from the markets in a repeatable cycle of trading boxes day in, day out, whether it's day trading the E-mini and 5-minute boxes, or it's putting on some longer term swings, either with the E-mini or some stock related names that are tied to the trend of the market. So let me start off with zones. Zones are important to me because they help me understand the short-term and the long-term environment. They help me understand what I might be considering as a bullish environment or as a bearish environment. And one of the last things we spoke about on our initial call was this 3,900, 3,920 area. So I wanted to go ahead and highlight that here for you guys. And let me extend it all the way over here. And so to me, I'm mostly focusing on this area here. I'm going to draw a box, right, or a range. I'm mostly focusing on this because this is primarily the main trading range that we've been in since May of last year. So in looking to see how I can possibly not only trade this, but look to see when I want to allocate some capital towards some longer term swings, I am referencing this 3,900, 39 level a lot. Now I'm going to draw a box here, and I'll get back to what this box represents, but I just want to highlight this range that we've been in. It's sort of been this range that started around May. Now, if you see this range, I like to, when considering a range, I like to look for what I call a bull or bear line, which pretty much is a line in the sand for between bulls and bears, right? That they are sort of telling us where what they agree is the fair market value, or as some of you guys may know, is the point of control. And to me, that is this 3,900, 3,920 area. Now you can see that whenever we come into it, we bounce. Whenever we come back into it after we break it, we sort of get rejected, right? So you can see that same relationship across 3,900, 3,920, all across this range. It's pretty clear what the market's trying to tell us. To me, it's telling us that when we get above it, the market's going to go up, right? As such, in this example here, it's not always going to result in a major change in the character of the trend, like starting a new bull market, but it's telling us that within this range, it's going to go up, and when we get below it, it's going to go back down to the bottom of the range, maybe a few levels down below. But that's sort of the relationship that I look to understand in this range, because it's ultimately what helps me dictate what sets the tone for the next few weeks, maybe for the next 2 months. And it allows me to participate not only in the uptrend of this E-mini contract, but also some other stocks that are setting up in a similar manner. And the last time we spoke, we were sort of at this, I discussed this last breakout higher above 3,900. And I don't want to do that. Let me take off these other arrows, because we were discussing that while we made this last attempt to get above 3,900, we then retested it and held. That to me was a confirmation that we would start an uptrend to where, well, to me, it would be more common sense that we would go up to this big 4,180, 4,200 area that served as resistance. And, at that point, then we can understand whether it does serve as resistance and we come back down, or if we continue higher. And we ultimately ended up coming back down. But the idea here is that whenever the market, I consider this the market, right? Because it's a derivative of the S&P 500, which to me is the top 500 stocks. Whenever the market gets above this 3,900, 3,920 zone, I put on my bullish hat and I get aggressive, and I start looking for not only swings that are in the same, will meet the same parameters of the box strategy, but also swings in the E-mini contract. And day trading, I want to look for bullish boxes that help me amplify that performance through day trades in the similar uptrend that the market is having. And so that's what this 3,900, 3,920 represents to me. Now we can go ahead and draw another one, which, as you can see, right after me explaining this 3,900, 3,920, you sort of get the idea that what supply and demand to me is there's zones. And so what I want to do is I want to plot different zones across the map to sort of get an idea of where we might bounce, where we might find support. And we can see that the range actually covers these zones here. And these zones, you can see the interaction. You can see how these zones really help you understand that supply and demand area, right? That changing character. You can see here that when we tested it on the first time in November of 2020, we had a pretty strong rejection. We eventually got above it. We consolidated above it. Similar thing to what I'm talking about in the 3,900 area, right? These zones ultimately represent areas of interest that I want to consider as my market filter in my positioning. So if we feel like we understand zones pretty well now, I can go ahead and move over to boxes, but that's pretty much a rough outline of what zones are. Once I go over the boxes and the trends, then we can spend a little bit of time on how I put those together and really show you an example of what was an all-in trade for me, something that we discussed in the last call. So those are zones. These zones, like I said, they help me understand the environment. They help me understand, regardless of what's happening in the economy. I know over the last few weeks, we've seen a lot of rough things, but we have to understand that as traders who want to consistently make money day in and day out, or every week, we have to live inside the current trend of the market. And these zones help us understand that. We're not focused on what's going to happen in a month or 2 months from now. We're not focused on the rate decision that's going to happen in May. We want to understand what is the trend now? What is the context of the price structure in the range that we're in? And how can I extract capital from the market combining those two, right? And for the last 9 months, all I've done was look at this big 3,900, 3,920 zone to dictate, hey, if we're coming down into this level, I am not looking to short down here. I want to see if we can find some sort of support, hold, right, by consolidating at it or above it, and then look for a reversal box or some way to capture the bounce. That's pretty much all I've done over the last few months. And you can see how, obviously now looking back at the 9 months, it does look like, hey, well, I could have shorted there, or I could have bought the dip there. You know, I'm not looking to sort of do that. I believe that in doing that, and let's say, hey, price is going straight into the zone, for example, in this initial drop, I'm going to buy the first touch to the zone. I don't really like that approach, because in doing so, you're not waiting for confirmation. I like to wait for confirmation because it helps me understand that buyers are indeed showing up where they need to show up. If they don't show up and I'm blindly buying this dip into the zone, well, guess what? I'm probably going to get stopped out on this other dip that crossed right below the previous swing low here, right? I'm most likely going to get stopped out there if my stop is right below that low. So I'm actually looking for confirmation. Eventually, this creates a box, which I'll go over in a bit, but that's what I'm looking for. That's why I use zones. I use them as reference points. Then I look for some sort of consolidation, either demand if it's coming into a support, or resistance if it's coming in an uptrend into support. And those are zones, right? That pretty much covers those zones. I plot them all across you know, the different time frames. I have another layout that is just only 5-minute zones, and they work extremely well for day trading. I mean, you'd be surprised how often these targets, you know, if you see like a 5-minute zone and you say, hey, I'm gonna target there, the market goes to it and it rejects to the penny. I don't know how, I don't know why, but over the years of plotting these zones, I've developed quite an eye for understanding where is that area of interest, and that's what we use to day trade. So now that we've used zones, let's go over into boxes, and then we will use trends. Boxes to me represent areas of consolidation, you know, what some might consider a period of balance. Certainly buyers and sellers do consider that, because when we are sort of in this week or 2-week or 2-month consolidation, or a 10-month consolidation now, we can say that, you know, inside this range, it's a pretty balanced market, right? There's no uptrends happening out of this that are creating new trends here. There's no downtrends happening that we can say, hey, we're entering the second layer of the bear market, right? Ever since this October low, we while the news is out talking about this is happening and this is going to happen with the world and this is what's going to happen with the economy, we can't, based on the price action, we can't agree with that. There's no trend happening inside this range. We're in a range bound market. I would agree with you that yes, in 2022, because price corrected through, or the market corrected through price, which to me, for those who don't know, the market corrects in 2 manners. Either we correct through time or we correct through price, right? When we're in a downtrend, the market is correcting through price. And when we're in a sideways range, the market's correcting through time, right? It's a big difference. So in 2022, yes, we were in a bear market. We were in a downtrend. We haven't seen that for the last 6 months. So to me, I cannot agree with other people out there saying that we're in a bear market, we're in a downtrend. That's not what the market is telling us. And ultimately, price is the most factual indicator on the chart. And I strongly believe that we have to respect that. And because we do get to put ourselves in that position, we allow ourselves to find the opportunities to help us extract capital now versus creating a bias from everything that's happening outside the chart. And, you know, looking to see, oh, you know, I mean, I don't know if you guys are, how active you guys are on Twitter or on social media, but how fearful were people just 2 weeks ago, right? Below this 3,900, there were so many people shorting it. They were saying we were going to go down to 3,600. Listen, if we're not able to break this 3,900, 3,920 zone, which to me, this is not a break because we're sort of just, chopping around in here. If we can't break that, we can't say that we're going lower because there's no confirmation for me that we're breaking it, right? So eventually bears got caught short, or they got stopped out, etc., in this downtrend here, while we just all we did was create a box above it, which to me is confirmation that we found demand. And what's happening now is that just this week we're breaking that. I mean, this has been a monster week for me. I prepared, with the box has met all my requirements, and it allowed me to not only trade this breakout the last 2 days, but also participate in some other box breakouts on the on stocks, right, in the NASDAQ 100, which is pretty much the leading sector in the market right now, along with semiconductors. And so let's go into boxes and what boxes represent. So I wanted to start off by going over, there's two types of boxes that I consider. There is what I call a 50 MA box and a base box. A 50 MA box is pretty much a consolidation through time. It typically lasts around a month for swings, right? I'm looking at a daily chart. It typically lasts around a month, and this is when price is consolidating around the 9 MA moving average. This yellow line here is the 9 MA moving average. And it's usually when the consolidation is taking place above or below the 50 MA. The 50 MA for me is the main driver of a trend. Since I'm focused on extracting capital in the next 1 to 4 weeks, the 50 MA does a great job at helping me understand the short term. By short term, I mean, a month-long trend. And as you can see here, after we consolidated from April 13 to May 20th, which is what, roughly a month, we get a breakout and we get a trend. And it happens to be that the 50 MA to me, again, is like the driver. It's the pushing force in either an uptrend or a downtrend. Now, base boxes for me are when that consolidation is maybe 2 to 4, maybe 6 months, just as in this July to October consolidation in 2019. And the main difference between this box and the 50 MA box is that the 50 MA is going through the consolidation. So you see it here in the middle of this range, while the 50 MA is below it. Yes, it does touch a little bit through this, but it's not in the same manner that this base box is in, right? This base box is pretty much a flat correction through time consolidation, and it's actually what gives birth to 50 MA boxes. So if you see this consolidation here, eventually it breaks out and you get this massive uptrend, which to me is what gives birth to the 50 MA boxes. You get a breakout, you get a 9 MA uptrend. I call it a 9 MA uptrend because it's just an uptrend that is pretty much hugging the 9-day moving average. As you can see here, let me make it bigger, a little bit bigger, just so more people can see. Eventually, after that 9 MA uptrend, we find resistance somewhere. If it's a big level, I drop zone, etc. And I look for a month-long consolidation. And guess what? This is a consolidation from November 18th to December 12th. Guess what? Almost a month. And to me, another way of me looking for a consolidation or that box requirement, right, is by looking at the squeeze, at the TTM squeeze. For those who don't know, the TTM squeeze shows you when the Bollinger Bands go inside the Keltner channels, and that gives you an understanding of a contraction taking place between those two indicators. And what the squeeze does, it's a visual representation of that. And the squeeze goes from yellow, which is a trend, uptrend or downtrend, into squeeze mode, which is black as a first, as a moderate, I would call it a moderate squeeze. And then when we see these red dots, you sort of get the most aggressive part of the squeeze. And that to me is a sort of, when you get to the consolidation to like the month end part, that to me is like the tightest price action in time, because it's been consolidating for a month. And that's usually when the red dot pops up. So that's another way for me to analyze that we are in fact in a box, because the indicators telling us what the Bollinger Bands and the squeeze is doing. So we get a 50 MA box, there's a breakout, I participate in it. I look to participate in the breakout only if the requirements for the box are made. I don't simply just draw a box and like, hey, oh, here's a box. It has to meet certain requirements for me to take those trades, because a lot of the times, one of the biggest turnoffs of breakout strategies are that you're getting stopped out a lot. And so I had to create a requirements, right, rules to help me understand what was the difference between what I consider boxes that would result in false breakouts versus boxes that would create these uptrends or downtrends for me, which is ultimately what I wanted to capture. Now, I do go through some false breakouts here and there, but if it wasn't for those rules that were created, I mean, I would be participating in a bigger amount of false breakouts. So eventually you get a 9 MA uptrend. Again, it all sounds very repetitive because it's a systematic approach, right? You're looking to participate in the same entry, have the same stop, have the same trailing stop. So because all those parameters are sort of repeatable through time, trading to me now becomes very simple because I know what needs to happen for the breakout to work, for the trend to work, and for the stop and the stop movement, and the trailing stop to work and stop me out of the trend when the trend ends, right? So the 90 MA trend continues. Eventually, it ends when we get this kind of pullback, and we get another consolidation here, which is another 50 MA box. Here's the squeeze, and if it meets all the requirements, I look to take it. And I say that base boxes give birth to those because, for those who may not be aware of Stan Weinstein's stage analysis, it's a pretty good visual representation of that. He goes over how this is a stage 1 consolidation, what I call base boxes, and this is a stage 2 uptrend. So it's a different, oddly enough, I created this before I read that book, so I wasn't aware of the stage 1, stage 2, stage 3, stage 4 trends and how they look. And it just it's great to hear from somebody so admired in the industry that what I created and how I follow trends was another way of looking at what he considered the different stages. So this is a stage 2 uptrend. I call those a 50 MA uptrends because it's uptrends that create 50 MA boxes, and I use those to capture the market. So now, I want to touch on, since this is the E-mini, to me, again, that's my market filter. You can imagine how the break of this base box was an entry line for me to participate in the bull market across other industries, right? My main focus is on the NASDAQ and S&P 500 components. And so when we get a big breakout like this, this to me, this type of box is a big breakout. This is what creates multiple trends across different sectors because it carries the market higher, right? Instead of participating in a trend here or there where you can say you are riding a wave in the ocean, this base box is what gives birth and allows you to participate in the whole movement of the ocean. And because of such, you're able to really capture a broad market rally that can take multiple months. Just after this 2020 break higher, we saw how many months. This was almost a year long in 2021. So the 50 MA boxes, the base boxes, they allow me to make an informed decision, right? And that is an entry with a risk-defined level where I understand where my stop is and I understand how much I'm risking as the percentage of my account, right? And it also allows me to understand what is my typical return on these boxes and sort of repeat that cycle over and over again, right? But one of the things with trading is that what stopped me before from finding profitability and being consistent was that I did not have an approach or strategy that helped me make informed decisions, right? Just how I touched on the zones, right? When people would short or buy these touches, you sort of don't have an informed information that's confirmed to you that's telling you that, hey, this is going to be demand or this is going to be resistance, because you're sort of waiting for that touch to happen. You short it because it went into an uptrend right into it. And guess what happens? Because it's such a strong uptrend, it's just going to break through that zone, right? So you want to wait for confirmation. Once you get that confirmation, you have informed information that you now can use that to make a decision to buy or enter that trade, right? That's ultimately what helped me. One of the things that helped me become profitable, because with this box system, once everything comes in place, once all the requirements are met for the box, I now place an informed decision, which is to buy that breakout. And from that point forward, be okay with the uncertainty of the outcome, right? But as long as I follow this process over a large sample size, let's say 1,000 trades, I'm going to have a positive expectancy and I'm going to create returns for my account. And so these 50 MA boxes or these base boxes are all that I trade. At this point, I don't trade anything else, even though the market's overextended or oversold. I'm not looking to buy the dip. I'm not looking to sell the rip. I need to find a place of equilibrium, which is what a box is, and look to participate in the breakout of that box. And so just how this base box, it gave you the relationship or the understanding of the interaction between the base boxes to the 50 MA boxes. It's sort of the same thing if we go to the 2020. We had a big base box here. And again, this is when the 50 MA goes through it. And this is at a point where everybody, I don't know if you guys remember in 2020, but everybody was looking to short here because we had gone up so much. Everything was happening with the economy. We were closing up restaurants. We were, the value of homes were decreasing. People were losing their jobs. Just chaos, right? Complete chaos out in the markets. This was also the time of the presidency, I believe, of Trump, and there was a lot of chaos with that political environment. And we're saying, what's going to happen with the economy or the United States if he gets elected? All of that doesn't matter to me. This base box represents uncertainty, and uncertainty is because we don't know exactly, or the market participants don't know exactly whether we should continue and the market's actually discounted for what it should be in 6 months and a year now, or it's actually overvalued and we need to have a retracement, right? So during that environment, price is fairly balanced, right? There's not that much demand to push it higher at the moment until some new piece of data comes out, whether that's an election outcome, whether that's new policies, new economical indicators that are positive, unemployment, whatever it is. All that data, what will happen is it'll manifest through price action, right? Those people who are focusing on that data will then make informed decisions. Again, similar to what I'm doing on boxes, they will make informed decisions to then allocate their institutional capital, right? We're talking billions. It is those people who are moving the markets. So all I have to do as a trader who focuses on price structure is wait for all that to take place, wait for those market participants to make those informed decisions. And through that, it'll manifest on price and I will get my entries and exits. So ultimately, we just have to look at price. That's my belief, right? Not everybody may agree, but ultimately that's what I choose to believe. And that's what I'm very opportunistic about it. And it has worked well for me. So as we can see here, everybody was trying, everybody, because I just saw it all over Twitter or social media, right? People were so bearish because of, Trump or this or that. I just waited for this. I kept telling everybody, I'm big on Twitter. I talk on Twitter all the time. I kept saying to everybody, look, here's the zone. We can see how it has served as support or resistance over time. Okay, let me make it bigger. You can see the same relationship as I showed you in the current 9-month box. It has served as big moments for us. When we broke it here, we started the downtrend. It was this moment that we broke that moves me to cash. I'm not looking to see how far it drops. I'm not looking to see. That's not my mission objective. If it breaks the zone like this, I'm moving to cash. I'll let the market figure out what it wants to do, and then I'll wait for a box again. So eventually, We went back up, you know, we faced resistance where? At the same zone. And what ended up happening in the space box? We were actually consolidating above it. Now, if you guys remember my conversation earlier on the current base box is how I wanted to wait for confirmation, which is a consolidation above or below a zone, right? That is telling you that buyers are stepping up where they want to, and they're holding price up against the sellers, right? And if the sellers can't push price down, then that's telling you there's more buyers than sellers. And to me, that is the confirmation I want to look for. And through that, I make my informed decisions. Eventually, we could not break this 3,200 zone. And because we could not break that, there was no reason for me to be bearish. And what I actually wanted to do was wait for a box to form and make my informed decision. Eventually, it did. And we had this massive breakout. And again, similar to here that it gave birth to 50 MA boxes, guess what? It gave birth to 50 MA boxes. Now, you know, you may see them, you may not, but here's one. Again, we can, another way of looking at them is for the squeeze indicator. And what happened? You know, every uptrend, I took them. Some of them worked great. We had big uptrends, like in this example here. Some of them not really, and the trend was very small. And you know, we extracted a little bit of capital, and the trend ended, and we took our stops. Right? No problem. As long as we can do this consistently over a large sample size, that's what I'm focused on. Right? I'm focused on the month end number, the quarterly end number, and the yearly number. I'm not looking to see if I make money day in and day out. That's not an indicator of success for me, because I understand I will go through stops. I will get stopped out a lot. But if I apply the process over a large sample size, I will reach my objectives in trading. And so that is, you know, a little bit of the relationship between the zones, the boxes, and the trends, right? I'm a trend follower by heart. I'm looking to participate in these trends out of there, however they may look. You know, in this example here, when we broke the base box, I'm looking to do two things. I'm looking to put on a larger position size for a longer term hold, because we are actually going to be starting a multi-month trend out of this base box, which is what gives birth to these 50 MA boxes, right? So I'm putting on a larger position size for a longer term hold, because I want to capture this regardless of what it looks, right? As long as I don't get stopped out, my mission is to capture this whole move, whether it's 3 months, 6 months, or a year. Now, while I'm doing that and I'm waiting for that, as these 50 MA boxes develop, I am now looking to capture the immediate trend out of these 50 MA boxes, however they may look, and participate in them until my trailing stop gets us out of the trade, right? And that's pretty much what I look to do on a monthly and weekly basis. Not only that, but when I'm looking to extract more capital on a daily basis, then that's when I have my day trading hat on. And as you see with this same approach, it's literally what we do day in, day out in the E-mini contract when we're trading futures. I am just participating in a 5-minute or 15-minute time frame, and I'm looking for those boxes wherever they set up, and I'm looking to participate in them. And whatever the short-term outcome is, I'm okay with it, right? If I get stopped out, if I participate in a big intraday trend, great. Any questions on this? I hope it has not been too confusing. I'm trying my best to make it clear.
We had one question from Patrick. I know there are certain aspects of your entry and exit criteria that you didn't want to discuss because it's personal to you, but are there any of your rules for entry that you would go into detail?
I don't want to go over the rules specifically. There are a couple, but I would say, you know, if you spend some time in understanding the relationship between the time that it spends consolidating in the box over time, and if you collect a large sample size of, you know, what I personally do is I have a library of every single box that I've taken, and I sort of categorize them into different shapes and different outcomes, right? If in a way this helps me understand the types of boxes that appear in the market, they're not all the same at all, right? Some are maybe 2 weeks long, some are a month or 2 months long. They have different boundaries, they have different price action inside of it. And I save them and I categorize them under different terms or names, because what this does is helps me amplify my, not only the knowledge that I have with these base boxes, but the experience and the eye that's needed. So in the future, as you're trading future boxes, for me, I now have a better understanding of what to look for, right? And if in the future I come across a box with similar boundaries, for example, a perfect example of that, let me delete all of this. You know, I've been really active on Twitter for the last 2 weeks, and I kept saying, we're gonna go up, because we actually had a very similar box. This box here is actually the same box as October 2021. So this is what I call a reversal box, right? In my attempt at understanding different boxes. A reversal box is pretty much a box that comes from after a downtrend, right? This is a downtrend, and it consolidates at the end of the downtrend, and then price reverses back up. Now, what you guys typically may see is a inverse head and shoulders. And while I don't typically look for those, I don't like them. I don't believe in them, because you know they're rough to understand when they're actually going to work, when they're not. Again, I stick to boxes. But you may see that this is an inverse head and shoulders. Great. Ultimately, what this represents is a consolidation, right? All these patterns that you read about in books or you watch on YouTube, they're all consolidating patterns in some way or form. So I strongly believe that a box actually gives you the best view of that consolidation. And so you see this inverse head and shoulders, you see this downtrend, right? You see all of that. So if we go to the current box that just broke out of, you see exactly the same thing. You see a downtrend, you see a inverse head and shoulders, right? This here. And not only that, but this is above, again, going back to my zones, this is above the big 3,900, 3,920 zone, right? So what does that tell me is that we're consolidating, again, above a huge weekly zone, which to me represents demand. So while everybody that I noticed on social media was shorting this 3,880, 3,900, thinking we were going to go down to 3,600, I was simply looking, and I was telling everybody on Twitter for the last 2 weeks, hey guys, we're creating the same box as over here. Why are we shorting these lows here when, again, to me, I call it the same box because I've seen boxes, I've saved boxes for so many years now that I know what the box is going to end up forming. And so what does this mean, right? I'm actually looking to participate in a bounce, wait for the consolidation, wait for the bounce into 40-20, 40-40, wait for that pullback. Again, I highlighted step by step on Twitter. I kept shouting at everybody, don't short, don't short, don't short. I'm very vocal on there. And I kept telling everybody, look, guys, we're forming the same box. This is finding support at 3,900, at 3,920. There's no reason for us to short. And so what I did, I put on a large breakout trade here. So for the last 2 days, I had a large futures trade. I had a large positioning across other stocks. You know, I had Apple, I've had semiconductors, NASDAQ, the S&P 500, right? Just knowing, you know, I know, you know, there's a big stigma around saying that you know what the market's going to do, but listen, if you follow a systematic approach for years and your setup appears every single time across time, you can get to a point where you know what the outcome is going to be. Now, I'm not saying I know what the trend out of the box is going to look like, but I know that as these requirements get met for the box, I know what the outcome will be. We're going to have some sort of break. Again, I don't know what the trend out of that break may look like. It may be a false breakout. It may be a different sort of price structure, but we will have a break. And so that's what I do know. And just similar to this October 2021 box, I knew what structure we were creating in this box. I knew that we were creating a head and shoulders inside this huge base box, right? And if this zone represents that line in the sand between bulls and bears, again, why do I want to short down here? I actually want to start buying. I want to buy the breakout, and I want to participate in that uptrend to wherever it takes me, right? Whether it starts a new bull market or not, I simply don't care. I'm looking to participate in this trend. And if we go up to this 4180, 4200, which I believe so, then great. I did my job, which was to extract capital from the market via boxes and trends in zones, right? So again, to go back to the question of what are the requirements for the boxes, you know, I don't really want to release them, but I will share that if you start collecting this data of boxes across time, I mean, just simply go back 10 years and save every box, go into different timeframes and understand the price structure in it. You know, how long has it been consolidating? What patterns do you see inside this box? Eventually, you'd have a better understanding of what constitutes a breakout versus not. What is, you know, the requirements that you want to see. Look, I'll go into an hourly time frame to show you guys the same type of relationship that I've discussed in the daily pattern. So if we go into this box, right? Let me go into the 4 hour. The same, I applied the same thing as I did for the daily. So I want to say, what is that line in the sand that separates the bulls from the bears? Okay, so to me, just how I drew this 3900, 3920, I'm looking for a zone in the middle, or actually anywhere that can help me understand that relationship. And if we draw a zone here at 3970, 3978, again, you can see that when we get above it, we bounce. When we get below it, we drop, right? We got above it here. We went all the way up here. We came to it. We initially bounced, but then we actually broke it. And what did that lead to? A drop, right? What did this retest do? It retested and gave you another rejection. What does this second retest do? Rejected and gave you another, right? So you can see the overall relationship. Eventually, before we broke out, we retested it one more time. And guess what? This time we moved forward and we actually broke the box. So you see that through multiple time frames, everything is being applied in the same manner. Because again, we have to understand that the market is nothing but fractals. Whatever's going to happen on the monthly or weekly time frame, it's happening on the 5-minute time frame, which is exactly why, yes, you can apply a day swing trading strategy to a 5-minute day trading strategy, whether you believe it or not, right? I know that's a big point of discussion in the industry, is that you can't bring that strategy same here. When your strategy relates to trends, and because the market is nothing more but trends, either an uptrend or a downtrend or a no trend, right? Consolidation through time, you can apply that strategy through all time frames, because that's literally what happened across time. Trends across different time frames. And so if you do that consistently over time, you know, of course it took me a while, right? It's going to take you a while, multiple years, to get to a point where your trading awareness helps you understand all these different time frames and all these different trends. But eventually you do get to a point where you are looking for the same thing and you sort of expect the same outcome, right? Whether people believe it or not, I believe we're going to go up to 4130, 4180, because I've just seen it so much across thousands of trades. I know what the average expected outcome of a breakout is. I know what the average expected percentage move out of a box breakout. Again, this is all data I've kept in a library, right? I've created my own library, which I highly suggest to everybody watching. Is you know, us as traders, we're data analysts. And if we don't collect that data and analyze that data multiple times, then we're not really doing our job to understand everything that's being presented to us, right? Because for us to make informed decisions, we need to have all the data available. So what I've done over the years is I've collected a library to understand what does a typical breakout looks like. What is the typical return on a breakout? What is the typical percentage move in a breakout or breakdown, right? I've collected all this data, and anybody can do that too. It's the work that you must do to get better at this, right? For those who are looking for profitability and to become consistent, you have to do the work, right? You have to sacrifice things and do the work after, you know, your shift ends or you get out of your job, the weekends. That's pretty much all I sacrificed in my 20s. I wanted this to work so bad, right? You guys know my story. I've been through so much. I wanted to help out my family so bad that I sacrificed everything. I sacrificed friends, relationships in order to understand this. And now I'm at a point where I understand trends. I understand what the market is telling me and how I'm able to then participate in that current trend in time, right? Whether people say, hey, this is overextended and let's short it, I'm looking to actually buy the dip, right? Via a box, of course. But that was a super long answer, but I hope it helps. Well, I show you the 5-minute chart for day trading. Let me go into that. Let me pull out the layout.
While you're looking for that, Ian also asked, does the length of the box correlate at all with the size of the breakout? So do longer boxes, longer consolidations usually equal larger breakouts? And does that affect your position sizing?
For sure, definitely. So, you know, we went over this this 2019 base box. When we have these base boxes, because they're giving birth again to 50 EMA boxes, right? So let me just say this: 50 EMA boxes give birth to 2 to 3 week uptrends or downtrends. And so from a 50 EMA box, you're looking to participate in a 1 week to 4 week uptrend, right? In a base box, because it gives birth to those 50 EMA boxes, you're looking to now participate in a 3 to 12 month uptrend. Now, obviously, this was short lived because what happened with COVID, but this gave you a 12% return from October 2019 to February 2020, which was 4 months, right? That's not bad. That it served its purpose. And so my position size does change when we get this sort of breakout, because again, you know, I share that these kind of boxes, there are what actually moves the ocean. They're not something that's going to happen with a wave where, you know, the 50 EMA boxes, to me, they represent a movement in the wave that you as the captain of your ship have to get over in order to reach your objective, your you know, your wherever you're going. The base boxes to me represent a move in the ocean as a whole, and that is literally what moves markets, right? That is when we see a complete broad market participation in all sectors, whether we go up or we go down for the next 6 months, 12 months. And because of that, I sort of put on my investing hat, right? And I say, I want to be invested, not looking to trade. I want to be invested in the market as a whole for the next 3, 6, 12 months. That allows me to fully participate in whatever comes, right? I'm not looking to take early profits, none of that. I've seen a lot of times where traders have, you know, they're up 5, 6, 10% in what is a multi-month move, and they're already taking profits because in the short term, it's overbought. You know, we have to really do the work to understand how that doesn't benefit you at all. And in order to really capture massive growth in the market, and as a result, growth in your accounts to take you over, you know, the next couple thousands or the next couple 100,000s, then you want to be invested for these kind of moves. So when we get this big range of breakout that we in, I mean, I'm looking to this type of box break, almost year-long move. This is either going to give us a 15 to 20% move to the upside or to the downside. I'm not going to say here and call it what type of break we're going to have, but just know that when we do break it, I'm going to be fully invested. And if it's a 15 or 5% return, so be it. But if it's a 20, 30% return that moves the market into new all-time highs, I don't care what's happening in the economy, I'm going to participate in it, because ultimately it's my family's economy that I'm worried about, right? And that I worked so hard to create. What does that first colorful indicator represent? It is I believe it's this one, is the TTM squeeze, and it highlights contractions across time from the relationship between Bollinger Bands and the Keltner channel, and they actually represent where price is squeezing or having the tightest range possible. And to me, that's what represents a box, right? It's a consolidation through time where there's really no trend happening. We're sort of bouncing back and forth between this box, and the outcome is why I ultimately look to participate. So this squeeze here is a good representation of that, and it's it's a great supplement to have because it allows me to now have a visual representation of what that squeeze looks like. Even though I do fairly well with these boxes, but it's just nice to have and have a solid an additional look at that box. Then the first one here, the second one here is the RSI. I just looked, to see the type of reading that we're having, and the bottom one is the MACD. Again, it's just another indicator to represent oversold, overbought, and I just look to see what it looks like around, this 3,900, 3,920. As you can see, we were extremely oversold in RSI. So again, if we're extremely oversold near the 3,900, 3,920 zone, why are people shorting it? Again, I don't know. I certainly wasn't, but that's a way that I looked for to participate in it. What do you think will be the market? What do you think the market respects, the zones or the economical, political market news based on your experience? So I touched on this a little bit, but I believe that whatever happens in the economy or political space eventually will manifest into price action. And it is through that price action that we'll see whether we did in fact find demand at this zone or not, right? So if we did not find demand, then it'll look something like this here, where we broke in September of last year, right? We broke this and we just kept going lower. That maybe something happened in the world where there were just the institutional participants were saying, no, the market's overpriced here. We have to bring it back down. Great. Then I use that as information and then I make an informed decision. Then for here, when we're getting all this bank crisis and political and all this stuff around, the US dollar and what's happening with the markets, the market participants say, hey, the market's overvalued, let's bring it down. They did not. So again, that manifested through price. Eventually those institutional players said it's not undervalued, it's actually, it's not overvalued and we need to bring it down. It's actually undervalued and what we need to do is bring it back up. So they're buying, and through that buying, it's what's create these bounces in the market. And then from that, I get an informed information, and from there I make informed decisions, right? So that is how it relates. That's how I see it, right? How the news relates to the, I do go over the MACD a lot. Again, I'm not, these indicators to me are lagging indicators. I'm just looking at for reference. It's price action in the box that I focus on the most. Mm-hmm. Question here is there any part of the strategy that is more discretionary rather than it is systematic, or is it 100% systematic? The only discretionary part is my box boundary. I've gotten feedback from a lot, and it's something I help people with. For the traders that I mentor, it's very tough in the beginning to understand what these boxes are, to understand what the boundaries is. Is it, sometimes it may be at these wicks, sometimes it's not at the wicks. It just, again, it changes based on the requirements, right? And that's the hardest part to learning. And it does require more discretion over a fixed rule that says this is the box, because the box's boundaries change. And so that is probably the only discretionary part of the strategy. Everything else is systematic. Where I take profits, where I get stopped out via trailing stop, where my position size, it's fixed, right? It's fixed across every trade, other than the all-in trade, which I will go over right now. But it's the box's boundaries, right? It's very, very, that I will say it's very subjective. And because of that, it's very hard to understand where the box boundaries are. Because ultimately, if you do draw them in the wrong place, you're going to be entering a trade that is at that point of the breakout, it's just overextended and overbought. And so when you enter it, you're actually entering right at the top of that short-term uptrend, and you're caught in a false breakout, right? So very hard for the boxes, but everything else is systematic.
Would you share an example of a box trade that did not work?
Yeah, this one here. So I'm just drawing the box, right? I'm not saying that this is the box boundaries, but I'm just covering, the whole range. Let me make it bigger. This was a trade that I took, and because I'm now looking to take off my trade, I'm looking to participate in a trend, as such, right? I ultimately got stopped out somewhere here inside the box, as this got rejected. And that's how they look like to me. I participated in the box break. It was all the way up here. Great. I was in the profit, but the next, even hours after entering, it came back down and it stopped me out. And it happens, right? You just have to collect that data, make some notes on it, what happened with the box, put it in your library of false breakouts, and just keep moving forward, right?
Was that like an FOMC move? Do you
Yes,
remember?
I believe so.
Yeah.
And regardless of those events, I still take the boxes because I cannot, as a systematic approach, I think of it like as an algorithm. An algorithm, if the entry requirements are met, it's going to press buy, right? So if my requirements are met, regardless of what's happening, I have to press buy and be okay with the outcome. Because if I don't do that over a large sample size, then I will subconsciously create fear around entering around those events. And that's going to decrease my personal performance from what the performance of the strategy is. And I want my personal performance to be as best as possible, the same as what the strategy was created to do, right? So I have to I think like an algorithm, and I'm extremely disciplined. My life of chronic illness have made me extremely disciplined. So I just take the boxes, I get stopped out where I need to, and if the next day it breaks out again, I'm buying it, right? Because it's met all my requirements. I don't care what happened yesterday. I don't care about the false breakout. And it is what it is.
Do you have a catalog of your boxes based around FOMC or interest rate movements or anything that's larger event? Do you track those stats specifically?
No, news-related events I don't track. I track the outcome of the boxes, the formation of the boxes. To me, that news indicator is, I'm not looking to make note of it because, again, the data that I'm focused on is the price action only, and whatever happens in those events, obviously will be manifested in price, and ultimately that's what I'm focused on, right? Yes, I can share 5 minutes chart, Jeffrey. Let me give that for you. So this is going to look a little bit different. Let me just show you the daily so you can get an idea of all these zones that I have in the 5 minute. Let me go to the hourly. So you see all these lines. It's hard to read, right? Because it's a 5 minute time frame. But just to give you an idea, I have every single 5 minute zone from 3,500 all the way to 4,300. It took me quite a while to plot them. I don't share them out for free, but it's a great indicator. Let me just show you guys my trade over the last two. I went 3 times my size on this futures trade, but for those who follow me on Twitter, I shared that as long as we were above this 4,000 3990 area, which is here, you can't really see it right now because there's so many things happening, right? I wanted to lean long and look for a breakout higher of the box, which let me actually just show you that real quick so we can focus on the 5 minutes. I'll go back to this in 1 second, but I just want to show you the higher time frame pattern. I have different layouts for different time frames. Okay, so here's a box inside a box, right? And I kept saying that as long as we were above this green zone, which to me, hopefully you can see it, to me represents the bull bear line that I've discussed, right? Where above it, we go up, below it, we go down. To me, that is the line of the sand between bulls and bears. So I, as a trader, for confirmation, right, the information I look for is if we get above this 3997, 4003 zone, I am now bullish, and I want to look to participate in bullish uptrends, possibly breakouts. Now, eventually this other box formed inside this bigger box, which I call boxceptions. And to me, those represent the tightest price action in the overall consolidation. And usually what happens is from this boxception, you get the break of the larger consolidation. You can see, you know, this is the left inverse shoulder, the head, the right shoulder. And to me, this 40.27 top of this box boundary was the breakout for me. So if we go down to the hourly, when we were over here, and as soon as we got back over 403, I said, I am now looking for 427. And if that breaks, I'm looking for 40.56 and 40.77. I put this on Twitter a few days ago, right? So guess what? So you have these are hourly zones, by the way. Again, I plot hourly, 5-minute, daily on different layouts, so I don't mix them up and sort of have a better structure. So now let me go to the 5-minute and show you how that played out in real time. So we broke this, you can see here 40.27, that was my breakout point. We got long on the break, price consolidated. I actually put on my biggest size right above this area. So we were consolidating in this range here, right, yesterday. To the traders that I mentor in my group, I shared, hey, once we break out of this, I'm putting on, you know, my large size to participate in the daily box breakout. So I'm using now a 5-minute time frame to give me a risk-defined entry for this this big up breakout that I expect. And so what I did here is I drew this zone here, which was the zone. I actually put my stop 2 points below it. And I said, I'm looking for 40.56, which we got yesterday, 40.56. And the next zone I'm looking for is 40.77. And we got that. The next one above that, of course, was 40.88. But just look at that, almost to the T, this one the same. So we put on this big trade here. I took some off at 40.56 and then I left the rest on for overnight. And then I put on a limit order to sell at 40.77, the E-mini contract. I had 100 contracts. I took off 30 here. I took off 70 here. And that was my trade, right? I did what I had to do, was participate in the breakout. I identified a risk-defined entry. And guys, I only had a 2-point stop. A 2-point stop, and I participated in a 30-point move, right? An extreme and incredible risk-reward ratio here. But again, this is because I understood what was happening on an hourly time frame, which I just went over that, and the daily time frame. So I had those time frames collaborate for me, right, to give me that information that I wanted, so then I can make that informed decision and capture the breakout trend. So I did just that. The group and I absolutely killed it. I haven't really traded this. This is not an all-in trade. I was just going over the 5-minute time frame for Jeffrey. I will go over the all-in trade, but I mean, it's a pretty good sized trade for me, right? I had 100 contracts of the E-mini. I don't trade micros, so it was a regular contract size, and it did extremely well. That was my trade. I haven't really traded today. I don't want to give back my profits, but as you can see, on a 5-minute time frame, this was some sort of box, and this is what I look to do on a 5-minute time frame every day. We get a box. If our requirements are met, do we have a squeeze? I look at these other indicators, etc. We take the trade, and guess what? Nice downtrend, right? Again, it's very repetitive. Yeah, either you get stopped out or you participate in the trend. That's it. It's what helps us capture growth, right? This month we've done 42% for the account that we sort of keep track of with the traders that I mentor. Year to date, we're up somewhere around 95%. I want to say maybe 92%. Our average return from day trading futures is around 20 to 30%. And again, this is because of the position size that we track. We risk 3.5 to 4% per trade. That is a little aggressive because typically what you see in systematic strategy creations is you typically want to risk no more than 0.5% to 2% per trade, right? 2% be on the more aggressive side, but because I understand this approach so well. I understand boxes, zones, and how the trends move. I am, the risk is, it's a question here, what's the risk again? It's 3.5% per trade. So think of it, if you have a $10,000 account per trade in the futures market, you're risking $350, right? So now you can do the math on how many points that may be, depending on your account size and whether you trade micros or the regular E-mini contract. If you have a $100,000 account, then you're risking $3,500 per trade. You get the idea. It's a fixed risk dollar amount, and through that, because our position size is fairly big, I would say, compared to other strategies, we're able to compound at a higher rate and reach these higher returns much faster, on a monthly basis, to create 20 to 30%. It's really not. It may sound like a lot, and it may be because what you typically risk is 1%, but because of that, again, aggressive risk that we put on, it's not really that aggressive, but I just it is a little bit higher than others, and because of that, you're able to compound at a faster rate. So let me go over the all-in trade for you guys here that I want to show. Is it this chart? Sure. So yes, question is, can your bot strategy be applied to any type of trading, not just futures? Yes, except currency markets and retirement stocks. And I say that because as a trend following strategy, you want to participate in trends. What you typically have in retirement-based stocks, I call them retirement-based stocks because these are usually high dividend stocks, utility-based companies, AT&T, Verizon, water energy companies, right? For cities, for industries, those type of stocks, they don't trend that well. If you look at Verizon or AT&T, they may trend for a month and then they're chopping around for 6 months, right? Similar with currency markets. Because they're just chopping around like that, I would not suggest this type of trading for that, because it's a trend following strategy. What actually works best for those markets is a mean reversion strategy, right? Because it's so choppy. And one thing that I will say is that you want to typically have high liquidity. So I stay away from small cap stocks, some mid caps. I pretty much want to stay above 20 billion or higher in market cap. And my trading universe, which you can see here, I've created my own watch list. This A+, B+, C+ list are the stocks that I've seen over the years trade extremely well with the box strategy. And it's mostly NASDAQ names, right? These large cap names. I'm currently long Apple. Apple has just broken out of a, I don't like that color. Apple has just broken out of a huge multi-month base box. I actually was in a boxception break, again, boxception, but it was a box within a box. I bought the breakout of this boxception. I'm currently in Apple. There's no reason, right, for me to not participate in this because this is a multi-month box break. And so, right, same with NVIDIA, huge multi-month box break, and look at the outcome of that. Do you not want to participate in trends like that? I do, and it's why I created the strategy, right? It just complements it so well for these A+ list, and it's actually a requirement, going back to the all-in trade, a requirement of mine to only do all-in trades in these A+ watch lists, because I know those stocks so well. I know how they trend from trading them for over the years that it's a big requirement of mine because it allows me to have the confidence to size up that trade. So let's go over my all-in trade last year, which I pretty much went all in, and I'll tell you why. It was this box break here. Let me actually delete all of this. I don't need it. I don't need this other indicator. So let me share. So this is some of the stuff that I keep in my library. Here's the, can I move this to the, yes. here is a all-in. What does an all-in trade mean for me? All-in is pretty much that I've used all of the capital in the account. So as I've shared before, I manage a $7 million account. And so I was pretty much $7 million in. Well, at that point, it was $6 million. I was $6 million into this trade here on this box break. And I'll show you why. And it was a very profitable trade. It made my summer. And I'll tell you why. So I'm big on, again, on data analysis. And I say that we need to understand and have all of the data to make informed decisions, right? I've categorized and labeled and highlighted, annotated every bear market trend since 1960. A big belief of mine is that trends replicate across time, across different times in history. So bear markets, because they're fractals, will trend the same. And I have a very good understanding of those trends and what they look like, that it amplifies my confidence in making these all-in trades, right? Because I know over a large sample size what a trend will look like. They may not look the same, but if you categorize them and label them, ultimately you'll find out that uptrends and downtrends can be pretty much brought down to 3 different types of trends. And I'll go over that. You have 3 types of breakouts. You have a breakout that shoots straight up, very little consolidation. For example, here, you see this breakout here went straight up and then it consolidated at the highs, right? So that's one type of breakout. Then the second type of breakout is you get a breakout in a retest, right? Similar to these. This is another box I participated in. You see how we broke out, we pulled back, retested it. This is a smaller consolidation, but similar here. We broke out, we retested it, came back in a little bit, right? Those are 2 different deviations of the same breakout. But as you can see, if you collect 100, 1,000 boxes with this similar structure, you eventually understand what that structure looks like, right? And because you can understand it across 1,000 trades, you can have the confidence to say, I know what this type of trend looks like. I know what needs to happen in order for the trend to continue. And I know what needs to happen in order for the trend to fail, right? And let me ask you, how many traders do that? Not that many. You don't have a library of 1,000 trade setups that worked or did not work, right? And again, that is the work that needs to be done to be consistent for the rest of your life. So that's the second type of breakout. The third type of breakout is where you have a break and then a consolidation a little bit higher. Let me see if I can find that somewhere here. Here's a good idea. So here's the break. This broke out and just consolidated near the top. I wouldn't really call it like a retest, right? It just consolidated. You can call it a bull flag, whatever you want to call it, but it just consolidated above the top, right? That's a third type of breakout. So eventually, through my history of collecting the data of these different types of breakouts, right? I've covered so many of them that I was able to identify 3 distinct similarities across the thousands of trades. And I've been able to categorize them into 3 types of breakouts. And that's pretty much what they are. So I now can say, I know what the trend will look like because I've saved so many of these trades that, you know, again, a lot of people say you can't know what the market will do. I'm telling you, I know what the trend will look like. I may not know where we'll be at in a month, 2 months, or 3 months. I'm not saying that at all, but I know what the trend out of this box will look like. And if that is the market, then sure, I know what the market will do. And I say that in the most humbling way because I've done the work to understand what these trends look like, right? So across time, just how I showed you guys how this was the same box, or how the current box was the same box as this October 2021 box, and it certainly was. You can do the work and find them. So eventually, I saved every single kind of trend and box from bear markets across different time frames, daily, weekly, and monthly, from 1960. And we had a 1962 bear market, a 1961 bear market. Here's, you know, a 1961-69 daily uptrend with boxes, a 1969 weekly trend, 1973, daily and weekly, 1982. You get the idea. I saved all of them, okay? And I annotated all of them, etc. So the main similarity across all of these on the weekly time frame is that, so here's the daily, let's go to the weekly. When this zone here breaks, which to me is what ends the bull market, when we pierce the weekly lower swing high, and we pierce it here, we eventually, have a downtrend. Gosh, I feel like my mouse is dying. We eventually have a downtrend that bounces up into the weekly 50 MA. You can see that here. It doesn't look all the same, right? It looks choppy. It is what it is. We have that bounce into the weekly at 50 MA. Here's the 1973 bear market. Let's go to the weekly chart. It's this one. We had a downtrend. We broke the previous swing high, downtrend, and guess what? We bounced into the weekly 50 MA, right? That was 1973. Let's go to 1982. We broke the previous swing high. We had a downtrend. We bounced into the weekly 50 MA. You see the pattern here? 2000. Here's the weekly. We broke the previous swing highs, had a downtrend. We bounced into what? The weekly 50 MA. And let's go to 2000. Again, we pierced the weekly swing highs, had a downtrend, went into where? Weekly 50 MA. So now let's go into the daily time frame here for the ES, or let's go to the weekly. And let me show you what happened. This is the last swing highs. You see this, right? Swing highs, swing highs, swing highs. So you draw a zone here. That to me defines when an uptrend ends. So guess what happened? We had a downtrend into summer of last year. And guess what happened? We had a bounce into the 50 MA. Funny how that works, right? It's almost like if the markets are fractals and they repeat through time. It's fascinating, really. So what did we get? We got a box here. And again, you can go to my Twitter. I was such a big voice in this. And I kept telling everybody, we're going to bounce, we're going to bounce. All these things are happening. I even shared my analysis on Twitter, right? I'm a big advocate for helping other traders. I know what it is, right? To go through those painful moments of learning how to trade, losing money, not sharing those losses with your family members or your spouse, right? I know all of that. I experienced all of that. So I hope that what I share on Twitter helps people. But all the requirements, the similarities happened this time. I identified my setup that helps me make an informed decision, aka an entry, and allowed me to participate in this downtrend, in this uptrend, because this uptrend that I was looking to capture was a move into the 50 MA. Now here, if we go down here, 2022 is that exact presentation. It's a downtrend, and this is obviously not to where we are looking at here on the weekly, where we actually went to the 50 MA. This was saved at an earlier time, but you can see how we started the uptrend. Let me see if I have a little bit more. No, that's it. So we were starting the uptrend. So I was looking for a move up here and then a continuation to the downtrend, right? Question marks, are we going to see the same thing? Guess what? We did see the same things. And so this is what gave me the confidence, again, because of my years of trading this strategy, because of my years of collecting that data, and I had no fear around putting on this large all-in trade, having my stop be somewhere in the box, one of my rules, and being okay with risking 5% of the account. I'm okay, if it's a $6 million account, I'm okay with risking $300,000 to participate in what I think is gonna happen. And guess what? Just like every other bear market in the last 70 years, it happened once again. And this $6 million trade allowed me to capture this trend with, and I extracted a lot of capital, as you can imagine, from the markets. I did what I had to do. Again, my job is to extract capital from the markets by participating in trends that happened above or below boxes. And if all my requirements are met, it's my job as an algorithm to buy it when it breaks, put in my stop, and let it do what it's going to do. Either I get stopped out and I lose $300,000 or 5% of the account, or I make 10, 15, 20%, right? In this example, it went up 8, 9%. But as you can imagine with futures, or I was all in SPXL, which is a 3 times leveraged S&P 500. And if we go to that, I'll show you guys what that is in returns. Sorry, SPXL. That was a 25% return. Now you can imagine what that is and the life-changing opportunities that can have in your life, right? So that is literally what changed my life, from growing up in food stamps and not knowing, you know, I'll share this. When I was going to college, all I wanted to do was find the job that would pay me $40,000 a year. That's how low my ambition was, because I didn't know anything else. I knew nobody with money. I knew nobody that made 6 figures, right? None of my family members, cousins, all lower income, right? To me, I consider lower income because it's, you know, with inflation, with the rise of cost of living, you know, it's very challenging to get ahead with a certain, you know, $50,000, $60,000 a year income, especially with rents and just everything, right? So now apply that to my family who was making $30,000 a year, it was much more challenging. And so for me to get the opportunity to participate in this with the $6 million, which to me, it still is a lot of money, right? Because I didn't come from that, and then capture that kind of growth. You know, I share that, you know, I have a mentor in life, and that it's a multi-millionaire guy who's very successful, has a lot of capital, and he's given me the opportunity to trade his capital. And eventually, you know, my job is to manage all of his money. And hopefully, if I continue to do a good job across time and participate and do my job of participating in just these trends, I'll get to manage, you know, 30, 50, 100 millions, which is pretty much my goal. And as a result, you know, I get to help people. With the more money I make, I get to help more people. I get to help more traders learn a strategy that helps make money, change their life around for their families, create a life that they envision for themselves or their families. And that's really my mission and goal. Thanks, Jeffrey. If it was wrong, what would I have done? I would have probably just saved it in the library, noted down what went wrong, and gone back to work, right? It's just one trade out of the next 1,000, right? That's how I look at it. I am not emotional to the outcome. Thank you. Thanks, Patrick. It really is one trade out of the next. And if you can sort of develop that understanding and that perspective, you come to realize that the short-term uncertainty of the trade that you put on, whether it's a day trade or a swing trade, in that moment in time, should not matter, because your job is to create an approach. Trading is a business, right? So just as a business sets out to offer a service or offer a product that is helping people in some way or form, or a business throughout time, that is how trading should be. You're doing a job to extract money. That is your service, to extract money over a longer time frame, right? So these trades should be considered customers, right? Whether they're buying from you or whether they're returning something, right? Whether they're doing a transaction with you or not. That's how I view it. And so when I put risk on and I allocate some of the capital for a trade, I think of it as marketing, right? In a business, you use marketing dollars to try and create revenue for the company. That is what I'm doing when I'm placing these trades. I'm putting marketing dollars out to create awareness for my business and give me the opportunity to extract capital or revenue for the business. So that is what I'm looking to do across time. And trading becomes really simple at that point. It does not become emotional. It does not become a burden. When I occur a loss, or even when I go through 3, 4, 5 losses in a row, I understand that it's more of the environment, just how we've been in a very tough environment for swing trading. I understand it's more the environment than my trading. And at that point, for example, in 2022 and most of this year, I've been mostly in cash for the swing trading aspect. I've been focusing more on day trading because, as you can see, if we're in a downtrend, there's no reason to, in 2022, there's no reason to put on longs for swings, right? They're not going to give you the same returns as if you're participating in this type of uptrend, right? So if we are close to this breakout and we break out higher and participate in this 10, 15, 20%, best believe I'm going to do my job and I'm going to extract the most out of this market, because I want to continue changing my life and my family's life, right? And all those others who join me in my journey, and to learn the strategy with the group of traders I mentor, and change things around or reach a higher level of success for our families, right? That's ultimately my mission with this. Is I've found success. I know where I will be at in 10 years from now, and if I can help the next Christian, right, who had this big dream at 20 years old of creating passive income because of how painful it was to go through 2008 after losing my kidneys and going through dialysis and going through a transplant and having my parents have no money left after that to get through 2008 as low income. I know that pain, right? And I know the pain of learning how to trade, but that pain of 2006, 2008 is what gave me the discipline to be consistent enough to give me the time to learn what I needed to learn, to get to a place so I can consistently extract money from the markets and change my life around, right? So I hope you guys have learned a thing or two about my approach. I hope this helps you make better informed decisions for your trading. I hope it helps you change your perspective around trading. And ultimately, the biggest thing would be is that I hope it expands your view of really knowing the type of work that you need to create, right? If I did not have the confidence to put on an all-in trade, I would not be making these all-in trades, right? And everybody, 99% of traders out there, social media, they will tell you, you should not go all in. And I agree with them. But if you do the work and you get to understand trends, which is ultimately how the market moves, it is trends, right? If you get to understand those trends, you will get to a place where you can change your life around. You just need to give yourself that time window to make the choices necessary to learn what you need to learn, to make better informed decisions that will turn around your trading. Mm-hmm. So that is all. Please, any questions or anything else that I can answer for you guys? That's the approach.
I would like to back up a bit to your earlier trading as someone who came from poverty. When you first started making big returns on a trade, do you feel like you had an uphill battle psychologically with accepting that you could make 1,000 a day, 10,000 in a week, now a couple million in one trade? Do you feel like that was an uphill battle for you? And also, how did your health conditions, do you think, shape your relationship with risk and losing trades?
That's a good question. Let me answer the first one. Yes, you know what's funny? When I started making these big trades and I was making 20, 30,000 a day, I was taking all these screenshots, right? Because I couldn't believe it. I was showing my brother, who's younger, my mom. I was like, Mom, I just made $30,000 in a day. This is crazy. I wanted to make this in a year after college, right? And now that, it's obviously a much different number now. I mean, look, I will share my losses. I've lost 600,000 in a trade, right? So to get to a point where I'm excited and just can't believe that I'm making a $30,000 trade, to now being okay with losing $600,000 and saying, hey, it's just one trade out of the next. That is a huge improvement, right? And that's not easy, and it's going to take a long time. But that is the trading awareness that you must grow to get to a place where you can say, hey, it's just a trade. It didn't work out. Cool. I got the next 1,000 trades coming. And that's how I look at it. You can message me on Twitter. Find me on Twitter, Jeffrey. What I've gone through in life with my health and this chronic illness I've had for the last 20 years, and before even getting sick, what I experienced with my sister who had the same disease. And unfortunately she passed away because she could not get a kidney in time. it really helped me create the discipline that a lot of traders struggle with. It's very hard for traders to find the discipline to wait for your setup, right? Patience is very tough. When you're looking and you're seeing price action go up and down, and you're saying, oh man, I could have made $1,000 here, could have made $3,000 here. But because of the lifestyle and diet I've had to create over the last 20 years, which is I had to eat a certain diet, I had to have a certain lifestyle, I've had to take medicine all of my life, and if I missed a certain dose, I would experience symptoms. I may have rejection of the kidney, right? Those are the risks that I'm looking at. I am considering risk as loss of a kidney, loss of an organ, experiencing dialysis again. So when I compare that to trading, it's such a big difference, right? I not only look at risk the same because I just see it as, hey, it's a little bit of money, because ultimately it is what you're risking per trade should be a little bit of money. And two, the discipline of creating this lifestyle and this diet in my early teens and in my 20s, when everybody out there in high school and in college is doing this and doing that, and you're sort of being left out. Very difficult to create that discipline in that environment. But through that, I've been able to create that discipline and that patience and just waiting for my setup, right? So if there's nothing happening when I'm day trading futures, I'm not pressing any button until my setup appears, right? Now I don't care. I've gone days where I don't trade because a box has not appeared. So that helped me a lot. I know that's not the case for many. And I would say 90–95% of people, it's very tough to have that patience and develop that. But that's something that I focus on with, the people that I mentor is, if you wait for this setup, you see the performance, right? That's another thing, right? A lot of us traders, when we start out, we don't have this understanding of a systematic approach, right? We don't know that when you create the strategy and you back test it, you get to understand what the performance may be, right? So you get to understand what a yearly and monthly outcome may look like. So if you were to say, if the yearly outcome is 50% a year for swing trading, great. If I have $100,000 in my retirement account or my IRA, whatever it is that you're trading, maybe you have $100,000 in trading money, you can say, if I trade this strategy, I will make $50,000 a year and more as you compound that account, right? So you see that whole process as you're creating the strategy. When we start out as traders who are reading books and watching all these YouTube videos, you're just learning discretionary strategies, learning buy support, buy this wedge, short this head and shoulders, right? That's all you're learning. You're not learning how to create rules and create a systematic approach. So you don't know what that year end or quarter end or monthly goal should look like. And because you don't know that, you don't develop the patience to say, I'm just going to wait for these setups to appear because I know from the work that I've done, if that is all I trade, I will reach this outcome. That's another big indicator of success, because when you do that work and you do realize what the outcome is, you can now have it easier to say, I'm going to wait for these setups and these setups, because if I can overcome these short-term challenges, right? Because in the beginning, you're not going to make perfect trades, right? You're going to have slippage. You're going to buy instead of sell. Your position size is going to be a little bit different, right? Eventually, all that gets corrected out, but you eventually get to a place where you now have it easier to wait for these setups, identify these setups, and do your best to say, I need to really sit down and follow this process. And as you see it happening on a weekly basis, on a monthly basis, that new feedback that you're getting amplifies your confidence and your patience to just wait for these setups, because now you have now you have the confidence to say, I know there's a setup around the corner that's coming. And if I just have the patience to trade that setup, I will continue to extract capital in the market, not a per trade basis, but over a long period of time. If the strategy does have a positive expectancy, you should be able to reach that outcome, right? Eventually, that was my biggest turning point, was when I transitioned from making all these discretionary trades to making this systematic approach. And it's really what really turned things around for me. And And there's no other way that I would ever trade ever again.
Great answer. Thank you.
No problem. A little bit too long, but you know, I hope it helps. I hope it helps everybody who's starting out, who is learning the ropes, and just know that, you know, if you do the work, it will pay off. Any other questions, my friends?
I think that's about it. Oh, we have one from Patrick.
Go ahead, Patrick. My journaling topics are mostly, you know, at this point, I don't journal. I've never really journaled. My focus has been on creating a library of what entries work, what exits work, what position size works, what trailing stop works, what profit taking works or looks like, right? I want to create a library of things that work and don't work, right? Because ultimately that is data that you collect. And when you enter into that feedback loop of seeing what works, what doesn't, you eventually get to sort of bring this larger data set into a more refined library that allows you to say, I know these type of entries work, I know these type of exits work, and then you go into system creation mode and you test out exactly what will give you a positive expectancy. So that is journaling for me. I don't journal my thoughts, I don't journal my feelings, I don't journal how I did that day. To me, again, to me, those are insignificant, because regardless of what I'm feeling or regardless of what is happening in my life, price action will do what it needs to do. So if I journal that price action over my feelings and my thoughts, I get to focus on the trend in play, right? The current trend in front of me, the current trend structure, the current zones that work, because my feelings and my thoughts don't matter, right? We think it does, but it really doesn't. You're an algorithm, right? You're supposed to follow these entries and these exits. And that's what I want to collect, because that is the feedback I'm focused on. So that's my journaling right there.
Great. Well, thank you for joining us. And in case anyone missed it, you can find Christian on Twitter as trading_boxes.